Here's how you evaluate real estate using the income approach. We're going to take you through just a quick scenario here. So the very top line here is going to be what the total income is for the year. These are all annualized numbers, okay? So for the year, this particular property is generating $60,000 in income. We're plugging a vacancy number. Now this number is a moving target. Again, this is going to be very dependent on the market that you're in. I'm using 5% in this scenario. So 5% of your 60,000 is 3,000. So we subtract these two numbers and you get an effective gross income of $57,000. That's what your total income is after all of your vacancy is accounted for. Next, what we're going to do is we're going to plug your operating expenses. So operating expenses, these will vary, of course, depending on the property. This is what I'm using in this scenario. We've got an admin number in case you have an administrative expense. We're just putting $1,000 towards that. R&M, repairs and maintenance. Now, every property you need to be budgeting for repairs and maintenance. If you're not using a repair and maintenance number, then you're not doing it the right way. You definitely need to be planning for this. So I used 8% of the effective gross income. That, of course, will depend on the vintage of the property, how old it is, how recent mechanicals are. So that's just going to be something you'll have to determine. Utilities. Utilities, we've used $3,500. Now, these are the utilities that the owner, the landlord, is responsible for. We're not accounting for the utilities that the tenants are covering, okay, because that's not a real expense. We've got property taxes. We're using $10,000 figure here. Insurance, $3,500, and management. I'm using 10% of the effective gross income, $5,700. We total these operating expenses up and you've got $28,260 for the year. Now the next thing that you do is you take your effective gross income and you subtract it from your total operating expenses. That's going to give you this very important number right here, which is what we call the net operating income. In this scenario, we're dealing with $28,740. That's your NOI. This is the number that we use then to determine what the value of the property is. Next step is you have to determine what the cap rate is. Now, cap rates will fluctuate depending on the market. It's something that you need to determine by talking to brokers, doing some homework. It depends on the asset class. It depends on the submarket that you're in, what cap rates the properties are trading for. In this scenario, I'm going to use a 5% cap rate. So the next step now, we've got our NOI. We're going to divide the NOI by 5%. But this is the valuation of this property using a 5 cap. This property is valued at $574,800. I hope this helps you understand the income approach. And for more real estate tips, follow me.